So welcome back. We're going to continue our discussion by looking at foreign direct investment, also known as, colloquially, as FDI. So foreign direct investment basically means that a multinational or transnational corporation invests money to start, acquire, or expand one of their affiliates in a foreign country. So in other words, they are buying factories, they are investing in a local affiliate to expand maybe retail or warehousing. Typically you're looking at things like funds used to train local employees, used to buy or build or expand infrastructure, or also to expand inventory. So things like that. So it's generally seen as a long-term investment in that country. Compare that to portfolio investment. And portfolio investment is typically seen as a short-run kind of thing. Seen as a short-run kind of thing. It's sometimes considered speculative. It's the purchase of stocks or bonds or other financial instruments in a foreign country by individuals, multinational corporations, or equity funds. The most common example that I can think of portfolio investment is the Norwegian Sovereign Wealth Fund. And the Norwegian Sovereign Wealth Fund is a very interesting story. Some of you may or may not know that Norway has a lot of oil wealth. Now, what they wanted to do was avoid what is known as the resource curse. And the resource curse basically means that when a country has some sort of an amazing endowment of a certain natural resource, they wind up kind of living it up a little bit, having a good time with that stuff, with those from the wealth generated from those natural resources, and maybe not investing in programs or projects that would be for the long-term benefit of that country. The first historical example of the resource curse that I can think of course, is Spain. As many of you know, Spain came to the New World. They took all these raw materials, but especially gold. They brought it back to Spain. And the Spanish, of course, what did they invest in? They, of course, high quality of life in Spain, but then they also invested heavily in their military. Some of you may know the story about the Spanish Armada when they tried to invade England, this magnificent fleet of Spanish ships, and then there was a hurricane, and all that money that they'd invested in the building and the maintenance of this armada to invade England was lost because of a hurricane. And of course, today, as you look, Spain is one of the poorer countries in the European Union because, again, they'd invested in things that would provide a short-term benefit with this gold. And of course, today, when you look at certain Middle Eastern countries that have oil endowments, they have not necessarily made the same kinds of investments in infrastructure and education that they could have with those oil revenues. Now, Norway wanted to avoid that problem. So what they've done is all the oil revenues are used to invest in stocks of foreign countries. For example, the Norwegian Sovereign Wealth Fund owns at least 1% of every S&P 500 company. Now that's a lot of money. And what that is used for, of course, you know that over the long run, all of those stocks together will grow, and it's used to finance their pension fund. So that's a good example of portfolio investment. Another one could be a given company buys stock in any other company or competitor, and they do this basically to kind of hedge their bets. They have some money left over that they don't want to use to invest in the company or infrastructure, so they do this as kind of a short-term way to hedge your bets. Now, some of you may be asking, well, where does foreign direct investment usually go to? Well, it's about 50-50, about 50% going to developing countries, and a little more than half going to developed countries. And there's kind of an argument for either one. Let's say you want to invest in a developing country. Well, there's some advantages with that. There may be tax advantages. Maybe the developing country doesn't have a robust tax infrastructure, so you can invest there and save money that way. Maybe they have natural resource endowments, so you can get cheaper gold, cheaper oil, cheaper whatever it is that that country has that your own country does not. And of course, in developing countries, wages are usually lower. Now, the bad side of this, of course, the workers, because the wages are lower, they may not be as educated. There may be political instability in those countries. There may be currency issues. The currency may not be stable. Those are kind of reasons against investing in developing economies. Now, you can also invest in developed countries, industrialized nations. And the advantage of that, of course, is, yes, the labor costs are higher, but generally you can think about the fact that the workers would be more educated, so they should be more productive. Currency fluctuations should be less of an issue. The political side of it should be more stable. And so you are basically paying a little bit more for labor and things like that, but there may be less risk associated with investing in a developed country versus in investing in a developing economy. Now, whether you look at developed or developing countries, the reasons of investing in a foreign country are pretty much similar. First of all, if you are a multinational corporation, you may wish to seek access to new markets. You may have a really cool product and you think that individuals in a foreign country might want to invest in that. Think of, well, I like food a lot, so I'll think of like Subway. You know, when Subway expanded into places like France or Germany, they were catering to those European markets, and that was bringing revenue back to the States. So they were accessing a new market that was unfamiliar with the Subway products, and therefore there's some sort of a novelty and therefore a competitive advantage. So seeking access to new markets is one reason to engage in foreign direct investment. Furthermore, you may wish to be growing beyond a domestic market. You've become thoroughly saturated. Let me give an example. Think of Starbucks. You know, there is a Starbucks on every corner. You can't get away from it. Now, when you go overseas, you're starting to see more and more Starbucks. Again, because the US market is completely saturated with Starbucks, and so the only way to expand is to go overseas. And then another thing is to generate some sort of an efficiency or lower your overall costs. Think of something like this. Maybe you have some very simple tasks that you need to perform within your country, but we have high labor costs. So you could export those tasks overseas and have individuals in a developing economy or a different country do those same tasks for lower labor costs. Or maybe we don't have certain natural resources, so we would start investing in developing facilities or production capacity overseas where some of those natural resources might be more abundant. So the idea is invest overseas in order to create efficiencies or lower your overall cost of production. Now, there are some things to keep in mind, I think, when it comes to investing in developed countries. Remember, actually this could be developing countries too. Remember that multinationals don't invest in a foreign country just because they're doing it for the goodness of charity or anything like that. That's not it at all. You invest in a foreign country because you are looking at it as a potential way to make more money than you had before. So it is an investment and you're expecting some sort of a return on capital. And of course, when these investments come to any country, but particularly less developed countries, there can be significant economic benefits or consequences. And generally, for the benefits, a lot of less developed countries have significantly altered their tax structures and their investment policies in order to encourage multinationals to invest in their country. The problem is there are certain negative effects of foreign direct investment. So first of all, a foreign company can squash local competition. I gave the example earlier of José Bové, and José Bové felt that bringing McDonald's to France would produce negative effects or negatively impact the economy of rural France because local French restaurants would suffer. Furthermore, multinational firms typically have their shareholders in their home country, and therefore the profits from multinational activity are repatriated back to their home country. And so the local residents don't get the full benefit of the multinational company's presence. Furthermore, there can also be a variety of social impacts, which can be negative. Things like a multinational coming into your country can generate higher unemployment. It can introduce new products to the market, which may or may not be positive. And of course, you also have to deal with things like multinational firms, because they're operating overseas, think that the rules of their home country sometimes don't apply to them. This has resulted in things like human rights abuses, labor abuses, environmental crimes. So there's a lot of positive things, of course, associated with multinationals going overseas. Again, bringing a lot of good products, bringing new management practices to a host country, but these are, of course, tempered by the negative effects. So what we're going to talk about in the next video are some of the international codes of conduct governing how multinationals can operate or should operate when they are outside of their country. I'm looking forward to seeing you then.